Indian fashion retail is evolving. Consumers are becoming more value conscious, smaller cities are driving demand, and brands are experimenting beyond their traditional categories. So, from zero debt strategy to 665 plus stores and its e-commerce play. On this edition of Big Business Bet, we dig deep into Cantabil Retail India's growth strategy. And for that, I'm joined by Mr. Shivendra Nigam, the CFO of the company. Mr. Nigam, thank you so much for joining me on WION today. Firstly, let's start by talking about the consumer behavior. Are people in tier 2, tier 3 cities really spending a lot more than what they were doing, say, until a year back?
So first of all, thank you so much for having me on the show. Yes, we have noticed, changes in consumer preference, specifically as you told tier 2 or tier 3 cities, or beyond that, even tier 3 and beyond that as well. So, penetration of internet has made the consumer a lot aware. Specifically, we are talking about whether it's Gen Z or millennial, any of the customer. But the awareness about fashion and awareness about current market trends are extremely high, right? Extremely high. Today, we are entering the world of AI, right? So yes, for the businesses as well, they have to keep themselves updated to have the continuous growth. So we are working on this as well, and because normally Cantabil is known as a basic fashions, right? For 5 days in a week we are champions, but 1 or 2 days is also required to be there. So we are continuously working on that. We are trying to gel up with the Gen Z requirement. So our fashion basket is also a 3:1 is the ratio we have been maintaining, because we are very high in terms of basket size. For garment per average bill value is our basket size. So we are trying to fill that. So, and continuously for last 26 years we are probably the oldest Indian brand as of now, which is growing like this. So we are continuously doing on this, and yes, we have not only all the businesses has to keep themselves in place considering the current market scenario.
Right. Mr. Nigam, speaking of the market scenario and the trends that you were mentioning, there's a very recent trend that's picking up because of sustainability, climate change. Gen Z is embracing this thrifting and repair, don't replace trend, right? Brands like Levi's, they are, giving way to it even further. So what is your opinion? Do you see this as a threat to fast fashion or as an opportunity for brands like Cantabil?
So anything, whether it's a fast fashion or sustainable fashion, ESG is a core basic requirement. We also, as a business houses, this is our social responsibility, whether it's a governance issues or the sustainability issue. So considering it's a gel in the fashion as well. But it's not anything will be changing, anything will be abolished, something. It is not about like that. But at the same time, you need everything considering the environment, specifically India. The environment is always on track. That has to be gel. So the fabrics are coming in that way where you can. So we are also working on that. And yes, sustainability is a part of all the things, including fashion.
Okay. And I also want to talk a little bit about your numbers. You've maintained an EBITDA of about 31%. So profitability goes very well for you. Just wanted to understand, what are the factors that you're able to protect your margins so well? Is it, bigger margins that you're looking at? Like, what is the key behind this 31% EBITDA that you have been able to maintain?
So we are always a believer of, rather than P&L and a cash flow, right? I'm a more believer of the cash flow. And all these EBITDA margin or PAT margins would be maintained because when we are in the fashion business of retail, when you are being able to deliver your gross margin. So we are continuously for last 5-6 years delivering our gross margin in the range of 58 to 60%. Because from the day one itself, I can have all the P&L and debit side of my P&L is always there, because mostly in retail, costs are fixed, rental is fixed. I know we are having long-term lease, 9 years, 12 years, 15. For next 12 years, I know what is going to be my rentals. Next years, considering the inflation, I know what is my salary. These 2-3 are the main costs. So for us, it is also very important how you are managing the gross margin. So we are probably the industry leader in maintaining the gross margin, 60% of the gross margin. Then this 30-31%, and there are chances a couple of percentage more would have been there. So the secret is that you need to optimize your cost continuously. You need to know very well the left hand side of your P&L. If you are being able to manage that, delivering continuously the gross margin, this EBITDA on PAT margin has always been on.
Okay, but for the layman, if we were to understand, would it be pricing power, supply chain? What exactly are you doing right to ensure this margin is?
So as I told, just to maintain these gross margins, there are few things, right? If you say pricing power, So at the end of the day, we are a very hard negotiator with all the vendors, not for here, for long, very long. And since we are a debt-free company, we are spended a lot, all from the internal accruals completely. So we have a negotiation power with the vendors, so which is protecting definitely our margin. We are working on some cash discount model because when you have cash in your kitty, you can deal with it, right? So it is all about obviously when the inflation comes, some portion of the inflation has to be bear by the end consumer, end user. So considering our, negotiations power, considering our better, better SOPs are in place, we are being able to maintain our gross margin, including inflation. There is some portion when the, raw material cost goes high, it has to be passed on to the consumer as well. So we are also there, but we are maintaining a balance to maintain this gross margin.
Okay, just one question I wanted to, ask. You spoke about any supply chain issues that might be there, or if there's any increase in raw material. Speaking on a broader trend, say for, you're preparing for your Diwali sales. For those, you will have to get in touch with your vendors, I believe sometime in January, February. And this is the time when we saw a lot of conflict. That's when it began. So has that impacted your business in any way?
Now the things are, mostly settled, right? When the war been started for last 6-8 months, the raw material price has definitely gone high, right?
Yeah.
10 to 15% raw material prices has gone high. Now it has been settled down, so we are not expecting much more in the coming days. Things are big global, global scenario is also settling up now. So we are not expecting anything going forward. Yes, but in last 6 to 8 months, definitely at around approximately 10 to 10% cost of raw material has gone right, which is coming down. Cotton prices has been settled now. Cotton prices went very high. Now it has been settled. It is coming down high. We are expecting not only the festive season going forward on a longer term basis. For long term vision, I don't think the raw material price is going to high. So things have been absorbed by us, by the consumer as well, and now I don't think inflation would be going forward on a longer term basis.
Okay, okay. And since you maintained a zero debt balance sheet, does staying debt free ever, limit you in any way when a big opportunity comes? Is that a hindrance at any point in time? You want to grab an opportunity, but since you are debt free, you don't have enough cash in the kitty to grab that.
Not at all. Not at all. We had never thought of it. See, what we personally feel, retail is no more number games. Way back when I started 20-25 years ago, how many stores you are opening, right? We are always been known as a long-term sustainable players, and continuous growth is our mantra. There is no point. There is no point today we are sitting at a 700 stores. There is no point of running 50% of the store in the losses and getting the numbers. No more game is like that. All our 700 stores are profitable. We have the opportunities in the market. Like this is the store where we are sitting right now. It is a 8,000 square feet. Our earlier size was 1,000, 1,200. Now our average size we are not opening. So the opportunities are there, but where we are seeing our P&L on a sustainable long-term basis, we are invested. We have enough. Last year, considering my deposit, I was at 50 CR in my balance sheet. This year, if the things will go like this, we are piling up with the cash. So not an hindrance. Cash has never been a hindrance for this. For last 7 years, till I joined the company 9-10 years, we invested 500, 600 crore and all from the internal revenue. Very robust business model. Cash has never been a hindrance. It is only the right opportunity and right investment which is going to pay us in a long term. We are only investing in that.
Okay, okay. And you said you have some 700 stores now across the country. What makes a store successful? And how do you get out of an outlet which is not doing well? How soon can you do that? What is the strategy behind that?
So for any of the stores, we also have a maturity period of approximately 2 years for the stores, of any of the stores. So there are basic parameters what we are opening, like on a per square feet, we have 1,000 rupees per square feet sale is to become. That is there. Then there is obviously location, because always in the retail, the long term going to is the location. That is why we are a high street brand. We are not a mall centric brand, right? So the go also. So it takes a time. Yes, closures come. When you have a 700 number, out of 100 stores you are opening, few decisions goes wrong. Then what is happening? We have a very less performance-based closure. The closures are like mall got failed, so the store shut down, the market got failed. These kind of things are really, but still we have a, you can say, on a year basis, 1% of the total stores are going for close for the performance-based side, and 2 years is our time where you have to give the store mature, right? When it is going mature, it has, because we have a very unique model in terms of our capex. This is all foldable model. If we are paying some deposit, 4, 5, 7 lakh rupees goes down, and we can move this fixed assets to another store. So we are in a very safely in terms of investment. Each and every penny counts. We see ROI in each and every investment.
Okay, okay. And now speaking of your stores, physical stores of course remain your strength. But how do you replicate that model in e-commerce as well without getting trapped in discounts?
So that's the challenge for us, not only for all the business. When you are an offline business in such a huge number of stores, so whenever the merchandise, all my stores are on omni-channel as well, right? Since we are changing new software, so some hiccups are there, but still all my stores are in omni-channel as well. So what the merchandise is available on the stores, the same discount would be available in the online website. All the leading marketplace players we are being there, and there is special inventory or aged inventory, which is specifically in an online platform that is sold on a higher discount.
Okay, okay. And speaking of categories, you are moving beyond men's formal wear into categories like women's, kids, athleisure, all of these categories. How can these categories become as big as your men's formal?
So, today we are having approximately 50% of total stores ladies, and they are the family store. That is why the bigger store. When you are talking about 2,000 plus square feet of the store, it would be family stores. There is actually 1,500 stores is available. It's a men's store. Then it is 2,000, 2,500 plus. It's a family stores, right? So as of now, my contribution for men is 81%. At the same time, we are opening specific ladies and kids exclusive stores. That number is 65 as of now. So there are men's store, another is family store, and then we have a 10% 65 store approximately now, the exclusive ladies and kids. Since this model has been tested for last 2 years, it's a successful model. They are not giving me the EBITDA as far as men. The moment it get mature, so that will also. So we are expecting going forward this 81%. Obviously, men's would have been there. 75%, and the balance. Today my ladies and kids category is giving approximately 13 to 14%. We are expecting it is going forward on long-term basis. Category should give us 20%.
Okay. Okay, so that's the breakup. And if I could ask you finally, what is the next big bet that Cantabil is placing over the next 3 to 5 years? And what are some of the biggest risks that you're watching?
So, Cantabil's plus is that by the end of this financial year, we are going to be a 1,000 crore revenue company. Last year, we closed at 853 crore. This year, we are closing, FY27 would be closing to 1,000 plus crore. Then in next 4-5 years, we are making it double whatever our plan is. So, the big plan next by the FY31 or FY32, you can say 32 safer side, because plus minus 10% always keep in mind. We are making from 1,000 crore to 2,000, and that would be a journey which we are working and going to be start. As far as threat is concerned, not much threat we are looking at it, because we are basically a KPI driven company. When you are KPI, we have never been hardly deviating from our basics. Honestly, fundamentals are very strong. Fundamental is not been proven now. It is for last 26, 27 years been proven case. So we are not deviating. We are not getting much affected by the, current trend, current fashion, current consumer preference has to be kept in mind. Production would be accordingly, and we don't see any much issues.
Okay. All right. Thank you so much, Mr. Nigam, for joining me on WION today on this edition of Big Business.
Thank you so much. Thanks a lot. Thank you.
Great. Well, clearly, Cantabil is looking beyond just adding stores. It's betting big on a wider consumer base, stronger margins, and diversified brand. That was Mr. Shivendra Nigam, the CFO of Cantabil Retail India on Big Business Bet.